Hi guys, good morning. Hope everybody is good. So this is class number 3, the last class of Forex. As you all know, we have started this revision of concepts series, and we have done 2 classes so far, and this is the last class. I am left with 4 topics, and once we are done with it, the Forex is done. Okay, so the first thing I want to discuss is the types of foreign currency accounts. You already are aware about it. There are 3 types of foreign currency accounts. I told you in the class this can be tested both for theory and practical. And there are 3 types of foreign currency accounts. The first is Nostro, next is Vostro, and the last one is Loro. These are 3 types of foreign currency accounts. You know, these names are in Latin, and the English meaning is what you need to write in exam. The Nostro stands for our account with you. Any Indian dealer, Indian trader having an account with Citibank in US, having an account with HSBC in Hong Kong, and denominated in foreign currency. If I have an account in US, my account will be denominated in dollars. If my account is in Hong Kong, my account will be denominated in Hong Kong dollars. Why such an account will be opened? Because maybe you have frequent transactions, or you have too many small transactions taking place in US. So every time you don't want to take the trouble of going to the currency market, you just want to have an account which facilitates the ease of doing your trade transactions relating to dollar currency or Hong Kong dollar currency or whatever currency it is. So Nostro is when you are referring to your account with some foreign bank denominated in foreign currency. Similarly, Vostro is when somebody from foreign country is having an account with you in rupee terms. With you in rupee terms means it's an Indian bank having an account of a foreign resident, and the account will be in rupee terms, like Mr. Sam from US having an account with SBI in India. That is Vostro account for SBI. And if you think carefully, this is a Nostro account for Mr. Sam also, because Mr. Sam this is a Nostro account. He will say my account with your bank, correct? And last is Loro account. So Loro account has very limited practical application when we are utilizing third parties Nostro account services. Any third parties Nostro account services, when utilized, we refer to it as Loro account. You don't directly have an account, but you're utilizing services of somebody else's Nostro account. That is what is referred as Loro account. So you will have to write the 3 types of accounts, give their English interpretations, give one example of each. This is how you can get 4 out of 4. It won't be tested for more than that. Okay, now what happens is, generally they can ask you a practical question on Nostro account for 6 marks, 6 to 8 marks they can ask you, in which, if you remember guys, I told you they will ask you to do 2 things. One is to prepare the account balance. When I say account balance, obviously debit and credit will be required over there, and one is the position statement they might ask you to prepare. So position statement, if you remember, we can have long and short. There are 2 types of positions possible, long and short. So basically they will give you some transactions. There are not variety of transactions, there are some limited number of transactions which are clearly given in our book, and based on those transactions they will ask you how the account balance and position statement will change. And after all adjustment of the transactions, they will give you some target account balance and position. Over what position means long, over sold position means short, and they will ask you to achieve that. So I'll give you some list of transactions, but before that guys, if you remember, I gave you 2 suggestions. Number 1, any transaction which involves actual cash inflow or cash outflow, any transaction which involves actual cash inflow or cash outflow will only be impacting my account balance. Otherwise my account balance will not be impacted. You remember that? Any transaction which involves real cash inflow or cash outflow will only have an impact on my account balance. Any forward transactions will never have impact on the account balance, because forward transaction will be settled on a future date, so that will not have an impact on my account balance. Any action taken by you, this is suggestion number 2, any action taken by you, whether to buy currency or sell currency, whether inflow happens or outflow happens, any action on your part will impact your position statement, which means the moment you take any action, a long and short will be impacted. Okay, So position statement will almost be impacted in all the transactions, but as far as account balance is concerned, we will wait and watch, and only when there is real cash inflow or cash outflow, then account balance will be debited or credited. Remember, the debit and credit is in terms of the foreign currency. It's a dollar denominated account. Okay, so in terms of dollar, you have to think whether dollar is coming in or dollar is going out, not in terms of rupee, guys. Like I give you a few examples now. Spot market dollar purchased. If spot market dollar purchase means real inflow is happening. Spot market dollar purchase means credit will happen, and purchase means long. So long will also happen. Credit and long will happen. Sold dollar forward. Sold means short. Forward means no real cash inflow or outflow has happened. So no, account balance will not be impacted. Okay. Now, a forward buy contract cancelled. A forward buy means long, is now cancelled. How do you cancel? To cancel, you do a reverse. So long would be cancelled by taking a short. So this will also have only a short position impact. Account balance will not change because there is no real inflow or outflow of the currency happening. Okay. Next, spot sell the currency. Spot sell the currency. Debit, sell means going out, debit, and sell means short. If I am spot selling the currency, it means money is going out of my account, so debit will happen, and sell means short. For this purpose, guys, I hope you remember this. I told you, if there is any remittance made by TT, telegraphic transfer remittance is done, I told you we assume such transactions are spot selling transactions. So if there is any remittance by TT, then in that case we will assume it to be spot selling transaction, and accordingly in that case both account balance will be debited and a short position will be created. Further, I told you, if there is a bill being purchased by you, purchased a bill, you think like this. I told you to think of it like it's bills of exchange. That is, you are today generating a bill, but settlement will happen on a future date. So any bill related transaction is a forward transaction. So if I purchase a bill long, sold a bill short, remember that. Okay. And lastly, I told you draft related transaction. So draft is just like a bank draft you make. So when you raise a draft, you know money will go out of your account. So there's a short getting created. Once you raise a draft, two things can happen. Either draft will be executed or draft will be cancelled. If draft is executed, then account will be debited. And if draft is cancelled, then short will be cancelled by taking a long position. Draft raised, short. Draft cancelled, long. Draft executed, debit. Because when you make a draft, it means you are going to give money to somebody, and in that case account will be debited. If draft is cancelled, first you did a short, now you will have to do a long. I hope, guys, this is clear, right? So these are some 5-6 transactions you have to keep in mind. The best way not to learn anything, but the best way to do this is just remember, if there is a spot transaction, buy sell transaction, account balance will be impacted and position statement will also be impacted. But if any transaction is forward oriented transaction, only position statement will be impacted. Account balance in such case will remain unimpacted. Okay, just remember that. Okay, the next topic of discussion was types of currency fluctuation risk. Now when I say types of currency fluctuation risk, there are 3 types. One is transaction exposure. We have done transaction exposure throughout our discussion. Transaction exposure is a situation when company knows what foreign currency they have receivable or payable, but they do not know what is the home currency equivalent, as the settlement is going to happen on a future date. It is the transaction exposure which is of prime focus in our curriculum. Transaction exposure hedging is what we studied throughout. The forward cover, the money market cover, netting, home currency invoicing, leading, lagging, all these things relate to transaction exposure. And currency futures and currency options also relate to transaction exposure. So we spend 99% of our time doing this, the transaction exposure. Second is called as the translation exposure. The translation exposure or the accounting exposure. Translation exposure is basically you have a parent companies in India, but you have subsidiaries or branches all across the globe. So you know, when you are preparing the consolidated financial statements, you have to take the books of accounts of these subsidiaries or branches and you have to report their figures also. So when you take these figures and you convert it into rupee equivalent, because see, if I have a subsidiary in US, they probably would be maintaining their books of accounts in dollars. If I have a subsidiary in UK, they would be maintaining their books of accounts in pound. So but when I am reporting all these numbers, I need to convert these numbers into rupee equivalent. So because of the currency fluctuations, we might end up over reporting or under reporting the revenues or the expenses based on the currency which rates whatever are prevailing. So this kind of a risk, when we are doing accounting of the entries or the transactions, or when we are translating the numbers from foreign currency into home currency, at that point of time, whatever currency exposure we get, that is called as translation exposure. Now when because of translation exposure a company ends up reporting higher sales figure or higher revenue, actually it should be considered as notional. Why I am saying it should be considered as notional is because it does not come from change in the fundamentals of the company. Like, company is not reporting higher revenue because they got new market share. Company is not reporting higher revenue because it got some new clients. Company is not under reporting its revenue because they lost some clients. These are fundamental changes, but actually there are no fundamental changes. Everything else being same, even if there is currency fluctuation, company might report higher revenue or lower revenue. So translation exposure is considered more of a notional kind of a loss or profit, and matured markets should not react to it. But if markets are immature, and in those cases markets do react, and practically if you ask me, markets do react to such news. They don't care whether revenue increase is happening for some fundamental or qualitative reasons, or it is happening just because of currency fluctuation risk. All they care is the revenue beating the market expectation, or is the revenue under performing as far as market expectations are concerned, and based on that share trading will start. Okay, the last exposure, guys, which is most important point of discussion right now, is economic or operating exposure. Now you remember one thing, guys, I told you that transaction exposure will arise. Transaction exposure will arise when three conditions are cumulatively satisfied. There is a cross-border transaction, there is a foreign currency invoicing, and date of transaction and date of settlement are two different dates. But even if you don't satisfy these conditions, it does not mean you are not bothered about currency fluctuation risk. What happens in such cases is you are exposed to economic or operating exposure. Now what economic or operating exposure is, I gave you a few examples. If you remember in the class, it's given in your book also, that economic or operating exposure is something you will be exposed to even if you are not doing cross-border transactions. You will be exposed to economic or operating exposure even if you go for home currency invoicing. You are still exposed to economic or operating exposure. How? I'll give you one simple example. Suppose I sell a machinery, machine X I sell for 60,000 rupees. Rupee per dollar is 62. Suppose there is Mr. Sam who is selling the same machine for $1,000. So the cost in India becomes 62,000. Is this maths clear to you? We in India are selling this machine for 60,000. There is Mr. Sam in US who is selling this machine for $1,000. Right now rupee per dollar is 62. So the cost in rupee terms happens to be 62,000. Suppose if you want to buy this machinery, would you buy it from Mr. KP or Mr. Sam? Would you buy it from Mr. KP or Mr. Sam? Answer is very simple. You will buy it from Mr. KP because Mr. KP is charging rupees 60,000 and Mr. Sam is charging $1,000. Now listen carefully. Second phase, which is after 6 months, rupee per dollar has become 58. Mr. Sam is still charging the same price and the price becomes 58,000. I am not doing business outside India, so there is no cross-border transaction, and accordingly I should not be bothered about currency fluctuation risk. Correct? I am not doing business outside of India. I am not having cross-border transactions, so I should not be worried about currency fluctuation risk. Correct? No, I should not be worried about transaction exposure, but there are certain risk factors which I will still be exposed to. How? If I am selling this machine only in India and I am charging the same price, but because rupee has appreciated against dollar from 62 to 58, as a result of that, imports will become cheaper for Indians. Now the same machine from Mr. Sam can be imported for 58,000 rupees as against 60,000 which Mr. KP is charging. In which case, you know what will happen? People will stop buying from me and they will start buying from Mr. Sam. So I will start losing my customers, or I have to reduce the price, in which case I will start losing my profit margins. Okay. Next, if I am now I'm giving you another example. If I am having foreign currency invoicing, that is when I have the risk. Now suppose I do the cross border transactions, but I go for rupee invoicing. Suppose for a particular product we charge rupees 50,000. Okay, right now rupee per dollar is 50, so 50, which means in dollar terms it is costing dollar 1,000 for the other person. But suppose I'm still charging the same price to my client in US, but suppose rupee per dollar has appreciated to 45. In that case, the cost for my customer in his currency will be 50,000 divided by 45. I'll get dollar 1111. If you see, for him the cost has gone up. How much has the cost gone up? If I calculate that, it has gone up by 11.11%. Now in such cases, if you remember guys, I gave you some trigger points in the class and I told you whenever they want to test you on economic exposure, they will not test you on this example. This example I've given you because this is one of the cases of economic exposure. But if they ask you practicals on economic exposure, then they're going to give you this kind of example where Indian entities charging in rupee. And then if you remember that Omega Electronics, some air conditioners are being sold to Germany, raw materials are imported from Singapore. That's some I'm referring to. So in this case, what happens is they will always give you elasticity of demand, guys. And in that case, what you need to do is you need to first find out, because of change in currency rates, how much extra or how much less the other entity has to pay. Then they will give you some elasticity of demand. Now you know elasticity of demand explains for 1% change in price how much the quantity demanded will change. So in this case, if the price is going up by 11.11%, so we expect that demand will come down by 11.11 into 1.25, which is 13.89%. so we expect that demand will come down by 13.89%. so what I'm trying to explain you is, even if you're going for home currency invoicing, there is no guarantee that you're not exposed to currency fluctuation risk. You will see, you will start getting approximately 14% less orders, which means earlier if you were selling 100 units of a product, now you would probably be selling 86 units of that product. And why, if you try to dig into this, that why did I lose my clients, or why did I start selling less number of units, the answer is pretty simple. Because in the currency market, rupee has appreciated, as a result of which they don't feel to import the good from India, which means we will be losing on our exports because they are not going to import, because for them the cost has gone up by 11.11%, and there will be some sensitivity in the market and you will lose your customers in that case. So long discussion short, if you are anticipating that you are not exposed to currency fluctuation risk because you are not doing cross-border transaction, or you are going for home currency invoicing, you may not have transaction exposure, but you will still have exposure to economic exposure or operating exposure. And again, I repeat it one last time, if they want to test you on economic exposure, first of all, there is a very limited variety of sums on economic exposure. But if at all they test you on it, then the only question that can come is with ED. So when you see ED, elasticity of demand, you will automatically understand it's a sum on economic exposure. The second last topic of discussion is NPV analysis. There are certain sums which are given in Forex under the NPV analysis heading, which to be honest should be a part of capital budgeting, but as I told you, they can still ask these questions, and they are frequently asking these questions in SFM paper. Okay, so I give you small understanding. Whenever they tell you find out the financial viability of the project, comment on the profitability of the project, in such circumstances you need to calculate NPV. What is NPV, sir? NPV is very simple. It is present value of cash inflows minus present value of cash outflows. How do you calculate present value? You calculate present value by discounting something at KC. What is KC, sir? KC, the most basic formula is weighted average cost of capital. We also refer to it as weighted average cost of capital. And KC, equity analysis chapter we have done, KC is calculated as WD into KD plus WE into KE. That is weighted average cost of capital. KC is used for discounting, or we also use RE for discounting. Last video I have explained how RE is calculated. So basically we use CAPM model. The CAPM model I will be teaching in derivatives revisionary classes. Okay, so NPV analysis, we calculate present value of cash inflows minus present value of cash outflows, and that's how you find out NPV. Now some important points which I told you to remember always is, number one, whenever you calculate NPV, you divide your cash flows into three parts: initial investments, operating cash flows, and terminal cash flows. initial cash flows, operating cash flows, and terminal cash flows. What are initial cash flows? Now listen very, very carefully, okay? What are initial cash flows? Initial cash flows is the investment in fixed assets and working capital. Initial cash flows is investment in fixed assets and working capital. So fixed assets like land and building, plant and machinery, furnitures, they will give you some investments which you are going to make in the beginning. Installation cost and all will be added to it. That's how you calculate the initial cash flows. What are operating cash flows? The idea of calculating operating cash flows is to come down to the figure of CFAT, that is cash flow after tax. Because you remember one thing, this present value of cash inflows is always calculated based on CFAT and not based on PAT. Never based on PAT. The cash flows, the present value of cash inflows referred to in NPV analysis is basically the CFAT, cash flow after tax. It is not PAT, it is CFAT. What is CFAT? CFAT is PAT plus depreciation. Okay, now the question is that why do we add back depreciation? I will answer that after some time, but what you remember right now is CFAT is PAT plus depreciation. Okay, and lastly so operating cash flows is that we need to come down to the figure of CFAT. If you just try to imagine that format in your mind, guys, it's given in your notebook in the class. I made you write it. We start with sales less variable cost is contribution, less fixed cost is EBIDT, then we reduce the depreciation, we get EBT, then we reduce taxes, we get PAT, and then we add back depreciation and we get CFAT. So first we reduce depreciation and then we add back the depreciation and we get CFAT figure. Lastly, we have terminal cash flows. Terminal cash flows comprises of again two things. Terminal cash flows is the cash flows you get at the end of the project. One is salvage value of fixed assets. You sell your fixed assets at the end of the project, and the salvage value which you get from it is to be considered. We should consider post-tax salvage value, because whatever salvage value you are getting, if there is a capital gain, then on such capital gain taxes have to be paid, and there is a recovery of working capital that will happen at the end of the project. Now if you remember, I told you one thing, that whether mentioned or not in the sum, you should always assume that at the end of the project there will be 100% recovery of the working capital. 100% recovery of working capital at the end of the project. Next is the point number 2. Why do we add back depreciation? The answer is very simple. We add back depreciation because it is a non-cash expenditure, and the only relevant purpose of considering depreciation is because it generates tax benefit, which means if from your PBT you reduce PBDT you reduce depreciation, it means you are only paying taxes on the net amount, because you know depreciation as per section 32 is an allowable expenditure. So you first reduce depreciation, and then after you have calculated your post-tax profits, then you add back depreciation, because depreciation is a non-cash expenditure, so we add it back. And the reason why we first reduce it, because we want to consider the tax benefit that depreciation will result in. That's the whole idea. Apart from that, certain other important points I told you is that we should always consider the sunk cost involved in the project. That is, you should be very careful when you're looking at your initial investments. If there is any cost which has already been incurred by you in the past, if there is any cost which has already been incurred by you in the past, then if you are now considering that asset in your project, then that cost should be ignored for the project evaluation. Sir, example is very simple. I purchased a land 5 years back. We just wanted to make some investment in real estate, so we purchased this land. It is lying vacant. So now I want to use that land for my project. I want to set up my plant on that particular land. The question is, this cost of land which you have already incurred 5 years back, would that be considered as initial investment in this project evaluation? Answer is no, because you did not purchase that land for this particular project. Incidentally, that land has already been purchased by you, and now you just plan to use it for your particular project. So remember one thing, any cost which is to be incurred for a given project, okay, that only we should consider. Any cost which has already been incurred in the past, that cost should not be considered. Any cost which is to be incurred because of a given project, then you consider that cost. But any cost which has already been incurred in the past, that cost should not be considered. Another important point is the opportunity cost of undertaking a project should be considered. What is the opportunity cost of undertaking a project? Like two examples I'm giving you. One example is the previous example, that plot of land which you purchased 5 years back, suppose is let out to somebody and you're getting an annual rental of 12 lakhs from that. Annual rental of 12 lakhs you're getting from that plot of land. But now suppose, because you want to use that land for your own project, so you will ask the tenant to vacate. You will ask the tenant to vacate that land. If your tenant is vacating that land, you know there is a clear-cut loss of 12 lakhs of annual rent. Because of undertaking this particular project, you lose this 12 lakhs of rental income. Because of undertaking this project, you lose this rental income of 12 lakhs. This 12 lakhs loss of income should be considered in project evaluation. This loss of 12 lakhs should be considered in project evaluation. Number one. Number two, if I am starting a new project, suppose I am setting up an amusement park, okay, and this amusement park is going to get us 50 lakhs of business. Now, because this is the second amusement park we are making in the city, some people find this amusement park to be more convenient distance wise or travel wise. Because of this, what will happen, you had another amusement park, but now your potential customers, they stopped going to that amusement park and they started coming to this amusement park. I hope you understand it. So what happens is, the moment this amusement park starts operating, you start losing 5 lakhs general income. From that general income, 5 lakhs of loss started happening, because it's actually not a loss, just that customer base has shifted from that amusement park to this amusement park, because they find it more convenient to come to this amusement park. So because of undertaking a project, because of introducing a new product, if I start losing my income on the existing product, then that loss of income should be considered as an opportunity cost. So for this amusement park, I will not consider my income as 50 lakhs. I will consider it as 50 lakhs minus 5 lakhs, which is 45 lakhs is what I should consider, because 50 lakhs I'm going to make from this, but because of starting up with this amusement park, I'm going to lose my income from another amusement park. That loss of income should be considered. And last important point, guys, is that when we are talking about the overheads, only those overheads should be considered which are additional overheads and which result from undertaking the project. Additional overheads should be considered. Any pre-allocated overheads, any predefined overheads for the project should not be considered. Sir, one example. I have given you class example. I am repeating that example itself. There is a building which belongs to a college. There are 3 floors, 1, 2, 3. 1 and 2 floor college is operating. 3rd floor is lying vacant. I approach the college and I tell them I want to conduct my classes in that floor. College is paying a rent of 3 lakhs. Please try to understand. College is paying a rent of 3 lakhs. So apportionment wise, they are allocating 1 lakh for first floor, 1 lakh for second floor, 1 lakh for third floor. In this case, if I go and tell the college people that, see, for you anyways, your floor is lying vacant, why don't you give it to me and take some charges from me on a monthly basis? Now, when college is trying to evaluate this project, or whether or not we should give KP sir classes for conducting his own classes, should we let it out or not, this 3 lakh of rental, out of which 1 lakh is allocated to 3rd floor, is irrelevant cost in project evaluation, because whether they give this class to KP or they don't give this class to KP does not matter. They will still have to pay 3 lakhs of rental. So any already allocated cost should not be considered in project evaluation. Similarly, another example I'm giving, this college at its premise has a guard, okay, security guard. This security guard is paid a salary of 30,000, 30,000. This 30,000 will again be allocated to 1st floor, 2nd floor, 3rd floor. Whether 3rd floor is operating or it is lying vacant does not matter, but cost is allocated. If KP takes classes or KP does not take classes, security guard will still be paid 30,000 and 10,000 will be allocated to 3rd floor. So this security guard charges, or this the rental of that 3rd floor, these are costs which we are not incurring because of offering the classes to KP sir. No. So these costs are irrelevant in project evaluation. But are there any additional overheads going to come as a result of offering 3rd floor to KP? Yeah, 3rd floor, if we give to KP, electricity bill will be a new cost for the college of 3rd floor. Maintenance cost will be there. Investment in furniture will be there. Giving a staff to KP dedicated for 3rd floor will be there. These costs are relevant costs, which only because of taking the project, these costs will be incurred. They should be considered in project evaluation. I hope guys you understood the important points in NPV analysis, and we come to the discussion of our last point of discussion, that is cancellation, extension and early delivery of a forward contract. Forward contract, the first part is cancellation. Guys, I told you one thing very clearly, that cancellation, extension, early delivery, these are influenced by RBI guidelines. Banks have very limited discretionary powers. Basically, RBI guidelines will be framed and the banks have to abide by that, and obviously the customers also need to abide by that. So the question is, will the cancellation, extension and early delivery be allowed? The answer is yes, it will be allowed, but then there has to be a genuine reason for you to ask for these things: cancellation, extension, early delivery. They might ask you to show shipping documents, they might ask you to show the trail of mails where you have been communicating with your client, and they might even take third-party confirmation. That is, they might ask your supplier or customer to give confirmation about cancellation of the order, or the extension of the payment confirmations, all these things. So number one, you be very clear in your mind, cancellation, extension, early deliveries are allowed only in genuine circumstances, when the client is actually facing hardships, only then it will be allowed. Number one. How cancellation is done? Cancellation is done by taking a reverse contract for remaining maturity. Reverse contract for remaining maturity. Reverse contract for remaining maturity. If you first have taken on January 1 buy $50,000 3 months forward, and on March 1 you want to cancel this contract, then on March 1 you will have to take a sell $50,000 1 month forward, because from March 1 you're still left with 1 month to maturity. So on March 1 you will take sell $50,000 1 month forward contract. I hope guys this is clear. So you take a reverse contract for the remaining maturity, and that is how you cancel your contract. Okay, can I cancel on maturity? Yes, you can cancel on maturity also. In that case, you would have done, if suppose you come on April 1, you would have done spot sell $50,000, not forward, spot sell $50,000. Can I cancel after the maturity? Yes, as per RBI guidelines, you can cancel within 15 days post maturity. You can cancel within 15 days post maturity. After that, bank will by default exit the position. Okay, so cancellation is allowed, and for that you will have to enter into a reverse contract for remaining maturity. As simple as that. Is extension allowed? Answer is yes, extension is also allowed. In case of extension, two things have to be done. Number one is you first cancel. And how do you cancel? Same thing, reverse contract for remaining maturity, and then what you do is you take a fresh contract for revised maturity. Fresh contract for revised maturity. You take a fresh contract for revised maturity, which means on January 1 I've taken 3 months forward buy $50,000. 3 months forward buy $50,000. On January 1 we have taken this contract. On March 1 I decided that I won't be able to make the payment on April 1, so I want to make the payment on May 1. So on March 1 first, what you will do, sell 1 month forward $50,000. This is cancellation is done, and on March 1 take a fresh contract. So from March 1 to April 1 is 1 month, and 1 month extension you want, so total is now 1 month plus 1 month, 2 months. So what you will do is 2 months forward buy $50,000. 2 months forward buy $50,000. So extension requires cancellation as first part. So if you know cancellation, reverse contract for remaining maturity, it's done. And from that date where you're standing, you will look at your actual maturity, which is 1 month, and then in that 1 month you will add another 1 month because you want extension by 1 month. So always remember, when you go and approach the bank for extension, from that date it is two things: how much is actual maturity left, and beyond that how much more time I need. So like that we take 1 plus 1 month, so total is 2 months. So we take 2 months forward buy $50,000 contract. So extension requires cancellation of the old contract and entering into a fresh contract for the revised maturity. In case of early delivery, okay, before I start with early delivery, in both these things, one thing is very important to remember: any profit on cancellation will be given to the customer, any loss on cancellation will be charged to the customer. Profit or loss on cancellation is purely belonging to the customer has to bear it. Okay, and last part is early delivery. In early delivery, what happens? It's very, very simple. So suppose if I have to settle on December 31, that is I have to sell $50,000 to the bank. I'm an exporter, I got dollars, sell $50,000 at 70 to the bank on December 31st, but I come to the bank on 30th November. I'm telling you from exam perspective, early delivery is very, very important for you, because early delivery is less tested in exams as of now. I think in last 4-5 years, I've only seen it once in the exam. So December 31st, I have sell $50,000 contract. So actually I should come to the bank on 31st December and sell $50,000 at the rate of 70. But I come on November 30th and I tell bank I want to sell dollar today itself. The question is, will bank allow early delivery? Answer is yes, as per RBI guidelines, they will allow. Not just they will allow you at the old contractual rate, which is at the rate of 70. So November 30th, you come and you will sell dollar at 70 rupees per dollar. Now what happens in this case is, November 30th, you will sell dollar to the bank, and what bank will do is, suppose this is bank A, and bank A will sell $50,000 spot. Whatever you sell to the bank, what will bank do with that money? Bank will sell $50,000 in the spot market. Suppose bank is selling $50,000 in the spot market at 69. Listen carefully, guys. Bank is selling $50,000 in the spot market at 69, which means they buy from you at 70 and they sell it in the spot market at 69. They buy from you at 70 and they sell it in the market at 69, which means $50,000 into 1, total 50,000 rupees is the loss which bank has suffered. That is the cash flow loss they have suffered on this 50,000. Suppose the interest rate is 12% for 31 days, the period of early delivery, they will charge you interest. For these 31 days. Bank has taken it from you at 70. They sold it in the spot market at 69, because that is the spot market rate. Because there is a total early delivery period of 31 days, whatever excess cash flow bank has suffered, on that they will charge you interest for the period of early delivery. So 50,000, suppose 12% is the cost of funds given in the sum. So 50,000 into 12% into 31 divided by 365, that is the interest they will charge you. 50,000 into 12% into 31 divided by 365. Now listen carefully. On 31st December, you would have sold dollars to bank, which bank would have sold to another bank in the interbank market, which means bank A is obligated towards bank B to sell $50,000. This is on December 31. So bank A, what it got from the customer, it sold it in the spot market at 69. Bank A, what it got from the customer on 30th November, it sold it in the spot market at 69. Are you understanding, guys? So now what bank A needs to do is, bank A is worried, oh my god, what I got from the customer I sold in the spot market, but I am also committed to give to bank B $50,000 on 31st December. So for this, what they will do, bank A will buy $50,000 1 month forward. Bank A will buy $50,000 1 month forward. So what happens is, after 1 month they will take 50,000 from the market and they will give it to bank B. Now this is where the story becomes a situation of a buy sell swap. See, they sell spot and buy forward. They sell spot and buy forward. Suppose they buy forward at 70.5 and they sell spot. So this results in a sell buy swap. Sell buy swap. Sell spot, buy forward is sell buy swap. You remember this. Sell spot, buy forward is sell buy swap. Buy spot, sell forward is buy sell swap. So sell spot is 69, buy 1 month forward. Why are they buying 1 month forward? To deliver it to bank B in interbank market. So in this case, 1.5 is the loss on $50,000, which is 50,000 into 1.5. If I do, I get 75,000. This 75,000 buy sell swap loss or sell buy swap loss will be charged to the customer. So customer in case of early delivery has two costs. One is, for the period of early delivery, on any excess cash flow to the bank, they will have to pay interest, and if there is any loss on the swap loss, that will be charged to the customer. So two things you remember, guys. Customer will be allowed early delivery. What customer gives to the bank, bank will settle in the spot market. What customer gives to the bank, bank will settle in the spot market. On this rate difference, interest will be charged for period of early delivery. And whatever bank needs to do for settlement in the interbank market, for that they enter into a fresh forward contract. Whatever bank needs to settle in the interbank market, for that they will enter into a transaction, and this forward transaction will result in a buy sell or a sell buy swap. Any swap loss on that transaction will be charged to the customer. Okay, I hope this is clear. And last part of our discussion is this very important point of discussion is this situation which you can see in front of you right now. This situation, I hope you remember, guys. This is a scary situation. This is the sum which has come so many times in exam. I hope you remember this particular situation where X Limited is going to bank A telling that I want to sell dollars 3 months forward. If you remember, bank A will go to bank B, and bank A will go to bank B and tell bank B that I will come and sell dollar 3 months forward to you. Do you remember this case of cancellation plus extension? I have told in class, very, very important case. So I'm just going to give you a broad picture about how to solve these sums. I hope this helps you. Listen, X Limited will go to bank A and tell I will come after 3 months to sell dollar to you. Bank A will go to bank B and tell that I will come after 3 months to sell dollar to you. Now what happens is, normally even if cancellation sums come, cancellation sums will involve only the situation of customer and bank A. They will never ask you questions on bank B, that is bank A and bank B transactions, that is interbank market transactions. But now what can happen is, they can ask you 2 questions from interbank market also. Listen carefully. X will go to bank A and tell I will sell dollar 3 months forward to you. Bank A will go to bank B and tell I will sell dollar to you 3 months forward after 3 months. Now if things go fine, then X Limited will go to bank A and give $50,000 after 3 months. Bank A will go to bank B and give $5 lakh. In this example is written 5 lakh. Bank A will go and give $5 lakh to bank B. If things go fine, then this will happen. But if suppose customer comes and he starts requesting for cancellation plus extension, if they start requesting for cancellation plus extension, like if you can see over here, customer comes and he's requesting for cancellation plus extension, then what will happen? Then in that case, first for cancellation, bank A will go to bank B and they will cancel the contract with bank B. How do they cancel? They will cancel the same way, that is by entering into a reverse contract for remaining maturity. They will take a reverse contract for remaining maturity. Okay, bank A will cancel with bank B by taking a reverse contract for remaining maturity. Listen very carefully, guys. Now the kind of sum we have done in class, there is a standard type of sum, and what we have done in that sum is that customer is coming late to the bank. Customer is coming late to the bank for paying the cancellation amount. See, suppose in the tier 3 market, that dotted line above that tier 3 market, X Limited has suffered a loss of 1 lakh rupee on cancellation. X Limited has suffered a loss of 1 lakh rupee on cancellation, which means X Limited should give 1 lakh loss to bank A. Bank A has suffered a loss of 60,000, which they have to pay to bank B. Listen carefully. X Limited, because X Limited cancelled a contract with bank A, so bank A had to cancel the contract with bank B. This part is clear. X Limited on cancellation should have paid 1 lakh to bank A, and bank A suffered a loss of 60,000, which they would have paid to bank B. So basically what bank A is doing, it will get 60,000 from bank A, 1 lakh from bank A will receive 1 lakh from customer and it will give 60,000 to bank B. This is the process. But suppose if X Limited does not come to the bank on the date of maturity and he comes on a later date, which means his maturity is on April 1, but he comes to the bank on April 15, then bank A will still have to pay to bank B 60,000 from its pocket. Tell me yes or no. Bank A still has to pay to bank B from its pocket. How much? 60,000. This 60,000 which bank A paid from its pocket for the period of delay, how many days customer came late by? 15 days. So customer for these 15 days will have to pay interest on that 60,000. Customer for these 15 days will have to pay interest on 60,000 to the bank, because bank A had to pay 60,000 from its pocket. So bank will charge interest for that period. Bank A will charge interest for that period. Customer would have given his loss amount of 1 lakh to bank A. Out of that 1 lakh, bank A would have paid to bank B 60,000. But because customer did not pay on time, so bank A had to pay 60,000 from its pocket. As a result of which, bank A will charge interest on 60,000 at the cost of funds, whatever is given in this sum, for the period of delay. I hope, guys, this is clear. That's question number 1 which they can ask you. How much is the interest that bank will charge to customer? Second, if you look at point number 4 written over there, customer is also asking for extension. And what I did in the class, that entire image is not getting captured. What I did in the class, I told you that for that extension purpose, bank A will take a fresh contract. It will take a sell dollar contract, another sell dollar contract with new bank C. Now if you look at 5 and 6, 5 you can see, right, cancel by buying dollar. So what bank A is doing, it is taking a buy dollar contract and it is taking a sell dollar contract. Look at those green lines. 6 is sell dollar and 5 is buy dollar. So first they buy dollar, who bank A, first they buy dollar to cancel with bank B, and then they sell dollar forward contract to enter into a new contract with bank C. Why did they take a new contract with bank C? Because customer is asking for extension. So this buy dollar sell forward, buy spot sell forward is resulting in a buy sell swap. This buy spot sell forward is resulting in a buy sell swap, and on that swap, if there is any loss, then that loss will be charged to the customer. If there is any loss, then that loss will be charged to the customer. I hope guys we are clear about it. Okay, so two types of questions can come. If customer makes any delay in making payment of his loss amount, then bank in tier 2 market has to pay its loss amount from its own pocket, which is 60,000 in my example. On that loss amount, whatever is the delay the customer does, for that period interest will be charged. Number one. Number two, in this case, if you remember, the bank is being told for extension. Because of extension of the contract, bank A will have to enter into a fresh contract with bank C, and accordingly what happens is customer has to suffer any loss resulting from a buy sell swap or a sell buy swap. In this case, first bank has taken a buy contract to cancel the contract with bank B, and then they have taken a sell forward contract for extension requested by customer. So this buy sell swap loss, if any, will be charged to the customer. These are two specific questions which they can ask you. What is the interest customer has to pay because of delay in coming to the bank, and what is the buy sell swap loss? That is swap loss they generally write in exam. Okay, so this is another sum which is very, very important from exam perspective, guys. I hope we have done everything, and these videos have been useful, guys. On an average, we have taken 150 minutes, which is 2.5 hours of total time. Entire Forex revision in 2.5 hours, I think, is a great job we have done as a team. And now it's up to you that if your sums in the class are done properly, if you have done the class notes properly, then I think this 2.5 hours of time should be sufficient enough for you to do multiple revisions. You can do as many revisions as possible, and I'm sure I haven't left any concept whatsoever. First video was all approximately 50 minutes, the second one around 53 minutes, and this is around 47 to 48 minutes, which means we have done comprehensive revision of entire Forex in 2.5 hours. Congratulations, I hope you enjoyed the classes. Best of luck, guys. Keep studying, stay positive, and prepare hard for your exams. Don't get carried away with the extra time that you have got for your preparations. You need to understand June is very crucial for you, because if God forbid something goes wrong, then the very next attempt will only fall within no time, because we don't expect November exams to get postponed. I hope you understand what I'm trying to say. I've already made a video on that. So please study as hard as possible, assuming that the exams are going to start from May itself, and make every day count. And soon I will be making revisionary videos on derivatives also. Stay tuned, guys. Bye bye. God bless. Thank you.